Right. So, Good evening, everyone. I'm Sumit from Tradewisenet, and today I wanted to talk about the ranging strategy, which I have explained in my book, and how I go about using it for my daily trading. Right. So, before I get into the strategy itself, a few things that let's get a few things out of the way. Um, One is that it's a high risk strategy, right? We aren't using stop losses, so we are going to be managing our trades. You need to keep, of course, your margin and lot size in check at all times. And yeah, there will, of course, or they can be drawdowns. So those should also be kept in mind when we are using the strategy. There are many positives. It does take the intraday noise out of the picture. Whatever movements happen due to announcements, for example, during the day, or if there are movements that happen because of any kind of changes in the market, those will be that noise would kind of be taken out of the equation. Um, it is a strategy which where you will see a lot of trades going your way. So it's a high win rate. Of course, there will be those that will be going against you, and that's where we will look at some of the trade management techniques. Of course, I'll talk about those during the video and where and how we've gone about trying to close them. Okay, so getting to the strategy itself, what we would want to do is start looking for pairs or trade those pairs that are pretty much range bound, right? Now we do hear things like price is the king, and price can move any which way, right? Of course, there are patterns and technical analysis that we do, but we would not want to bank on those things, as it can, sometimes it can go for you, sometimes it can go against you. So we would start with looking for pairs that are non-directional or are range bound, right? So if I look at so these are the so you see the screen here, you see the pairs which are enlisted on the right side. These are the pairs that I'm usually trading. They are pairs which are traded, or these are currencies that are traded frequently, so as such you see a good spread for them, close tight spreads, right? So let's start with okay, we've got the Aussie dollar and the Swiss franc. So one thing that we will do is, okay, we've got the daily time frame open. Now, first of all, let's zoom out. Let's go to the monthly time frame and probably look at some of the historical nature of this pair. No need to go too far back. If we can look at the last 10 years, I think that should be good enough. So yeah, so if I look at the last 10 years, let's say from 2016, from here, overall the pair has been quite bearish, right? So it's really going in the downward direction. And I've put a label there to say it's bearish. So it would probably difficult to trade this pair in both the directions, having long and short trade. So we will keep this pair out, right? Not a great pair to trade this strategy. We go to the Aussie dollar and the US dollar. This pair, if we see from 2016, the last 10 years, it's been quite flat. Overall, there was a period from, let's say, 2013 to 16 where it came down, but after that, it's been fairly flat. So if I have to draw a couple of lines to demarcate the range, that could be one. And if we take that as a peak downwards, we can say that is a range wherein it has been trading for the last 10 years, right? And I'll talk about how we will use this range, but this is a pair that we want to trade, right? So I mark that there with a color. CHF, JPY, well, this is an easy one to point out that we will not want to trade this pair. It's a bullish trend that it's been having, with the Swiss franc being quite strong, going in one direction, so we will not trade this pair. No range here. Euro AUD, last 10 years, it has been on an upward move, and it's probably at the top, reaching the top of where it has been. So if we have to draw a range, we can probably draw that, and if we omit that peak, it's probably at the top of where at the top of its range. So if we have to trade it, we would have to be a bit careful. It has been going sideways for the last few years within this range. So okay, let's keep this one, as it'll be a good example to talk about. Euro USD, I was drawing a few a few range or trend lines there, so that's why you see the markings. But okay, but it's for the same thing. 2016 to now, but approximately 10 years, it's been ranging between 1.05 and 1.25, two ranges. We will be quite happy in trading this pair. GBP AUD, a similar thing, ranging between 1.585 and 2.25. So that's where these two dotted lines are drawn to show the range. Happy to trade this pair. Let's go with that. GBP CAD, similar thing, really working within this range. In fact, for the last 8 years or so, you can even draw a line there, or horizontal line there, that's been working within it, but within this range. But because it's at the top of this range, it may break out. So let's keep, give it a little bit of room, and say that 2.1, 2.09, and 1.5 is the range where we will be looking at working in. So I'll mark that one as well. USD CAD, again similar. Here it's between 1.2 and 1.46 within this range. Happy to trade this pair as well. Mark that with red. GBP USD, now this has been coming down from 2016. It is well, if I have to draw a range line, just like the trend line, I call these range lines. It has been coming down, so we have to be a bit careful, but overall it has been within this range. So I'll go ahead and say I will trade this. Euro GBP, again, this has been trading well in the last 10 years or so, between 0.82 and 0.92. That's quite tight, and so we are happy to trade this pair as well. Silver, well, silver has been a bit all over the place. It went up, came back down, and it's going back up. Now, as a rule, I would probably keep out of metals, as they do have a tendency of going up, so I will not trade a metal, but there are exceptions. Of course, if you want to draw a range line, you can pretty much do that, and you can do that, but then you will be at the top of the range, and that may not work out to be the best possible thing to do. If I draw those two there, it'll be at the top of the range. So silver has been quite strong overall, so I would probably not pick silver as a pair to trade. Aussie New Zealand, So this is a good pair to trade. Of course, you can see this ranging that's been happening since 2014 or so, between 1.01 and 1.17. A good pair to trade. Let's go with that. Um, just to explain, the concept a little further, we have been trading the indices. Now, if you see the US 2000, that's the Russell. It has an upward tendency, right? So not a ranging pair. So basically, we won't pick this pair to trade, and that is because we can't be placing trades in both the directions. However, what you can do with indices as well as metals like gold. This is a gold pair, and you can see how strongly it's moving in the upward direction. Is to take trades only in one direction, and that is up. And probably a similar thing for the some of the other metals as well. Right. So now what we've done is that we've got the pairs that we would want to trade. Now, because we are trading on the daily time frame, so I'll go back to the daily time frame and start with the first pair here. And let me pick a time frame. Let's say, well, the 1st of Jan 2021. I have that ready, so let's just go with that. Not cherry picked, just something which is in the past. Right, so there we are. And in terms of taking the trade, so you can of course see the TWA indicator on the chart there. The settings are standard, length of 10, multiplier of 1, and a smoothing factor of 72. So that's standard what we do, and we are just going to keep it really simple in terms of taking trades. Right, so we start with from January 2021. The first trade that we get here is on the 11th of Jan, which is a sell trade. Now we will be taking all new trades as they come up, right? So there's no filtering that we need to do here. We get a sell trade, so we take this sell trade here. Let me put a mark there just to say, okay, so we've taken a sell trade there on that red bar. Goes for us, and then you get the next full red bar, which you can see here from, you can read here in terms of the fullness of the bar. So you can see that on the 18th of January, we get 100%, and that is when we will close this trade. So the first trade is fine. The second trade that we get is a buy trade, 21st of Jan. So let me move this circle here, that now this is the trade that is on. It doesn't go for us. Now this is important. We don't close that trade. All right, so we will be getting into a drawdown now, but we do get a sell trade on the 27th of Jan. And that is, so let me put another circle there. That is that again. So that's the second trade that we are now in. Right, let me make that's all right. It's a bit small there, but still visible, so that's fine. So now we are in an open trade here, and on the long side, but there's a sell trade that we get into. We keep going. We don't get a full red bar, so this is also a trade that's on the open side. It keeps going, but there's an important thing that we do here, that when the trade goes against us, so let me draw a horizontal line here to say this is a buy trade. The moment we take a trade in the opposite direction, I would put this buy trade at break even. So we are basically looking at getting out of that as soon as the break even is hit. So if I have to just write a note there, so I will say put at break even, right? So this is at break even now. The sell trade that we took here, That has also not gone for us, and we get a buy trade. So we will take a new buy trade on the 8th of February, and we will put this trade also at, so down this trade here, and we will also put this one put at, basically saying that the profit, you can put a take profit at 0 or 0.1 or something like that. So you put it at break even. You get yeah, so we are into a new buy trade on the 8th of February. And it goes for in our favor on the 19th of February is when we close that trade in profit. What we also see is that the previous trade that was open on the 21st, that we opened the 21st of Jan, has closed at break even, right? So we are absolutely fine now, and no open trades on the buy side, and we are in profit. This one closed at break even. Similarly, we then go and get the sell trade on the 26th of February. We take that trade, goes in our favor. On the 5th of March is when we get the next full red bar. We close this trade in profit. And in the next bar, we see that the previous open trade closes at break even. So as such, because we are really letting the price move within this range, you're confident that it's going to keep moving within this range, we are able to close these two open trades at break even and the others in profit, and we continue this way, right? So this is how it would go about from trade to trade. And typically what you see is that the trades keep going, and then there comes a time when you go out of the range. Right now, what we would, so let me get rid of these lines and see and pick a place where the trades have gone wrong, right? Or it's gone out of the range, right? So this has been fine. Now, let's say on the, okay, that's too far back, but we're talking of 2016, so let's say we are here, right? Now this went out, we drew that line, 2nd of March 2020. So let's go to the daily time frame. We need to go to the 2nd of March 2020. So let me do that. 2nd of March 2020. So that's March 2020 basically. And this is where it went out, right? Now, in this case, you would have taken this is the daily time frame, you would have taken this trade and anyway closed it here, right? And so you would not be worried about this going out. But if you do get into a situation, I'm going to have to find a scenario wherein the price has gone out. But let's say that, let's say you've taken a sell here, right? This is the first red bar that you got, and then you are stuck on it. And then it went against you and you got into a buy trade, and then the price didn't come back. What we would essentially do is, specifically for this one where the price had gone out and we had taken a trade, we would be looking at using the offsetting hedging strategy, which we have used, which I've talked about in another video, to cut the losses here and get out of this trade, right? Another thing to note is that whenever the price is going out of our range that we have marked, we will not get into a new trade there, right? If there is an old trade that is open and we are going out of the range, we will use the offsetting hedging strategy, or normal hedging strategy, um, or even look at the DCA strategy. Any of those to try and offset our losses and manage those trades. Right. So that kind of brings me to the end of the explanation of this strategy, and I will be, of course, talking about more examples in the weekly videos. So keep an eye on those. Stay tuned, and yeah, happy trading, everyone.